Welcome to This Week in Money, the source for market opinions. Here is Phil Mackesy.
David Morgan is our guest. You'll find him at silver-investor.com. It's the home of the Morgan Report. Hey, David, it's good to have you back on This Week in Money.
Phil, it's great to be back with you.
Hey, before we talk about the Vancouver Resource Investment Conference and what was going on there, I want to talk about the Morgan Report. There's a rumor I've heard that it's free.
Well, it isn't and it is, and of course that's a misstatement, but basically it's a paid service. There's 3 levels of service, but if you want to try it out and you're on our free list, in other words, if you just go to the website, silver-investor.com, and sign up for the free report, which is free forever, one time during that process of the first few weeks that you're on there, we do an offering, and that offering is to try the full paid membership for free for 30 days. And a great percentage of people that take us up on an offering actually stick with us. Now, a lot of people, of course, bypass it. It's your choice. But it's a way to get it for free, yes.
Place to go, silver-investor.com. Now, let's talk about the show in Vancouver this weekend, the World Resource Investment Conference. You were talking about silver, the move ahead.
Absolutely. You know, I try to point out, and I think I made a strong case, that one, the bull market isn't over. Any metrics that you want to use using gold or silver or both shows that we're far from a top. I went to the average between the Dow gold ratio, the silver Dow ratio, what markets have done in the past, how it compares to bubbles in the past. But more importantly, I pointed out in the last bull market, especially in silver, gold did it similar, is that the big run was in the last 12 months. Actually, it was even less than that. It was just in a few months. And the old adage that I've been kind of harping on, that 90% of the move comes in the last 10% of the time, I did the simple arithmetic, and basically 87.5% of the move came in the last 7% of the time. Now, that doesn't mean that this next market is going to repeat identically. What it does suggest strongly is that silver and gold are going to act like all markets do when they get overbought and are overvalued. And that means that they're going to be at a very rapid move up and up and up, and even the bulls are going to say, oh my goodness, it can't go up, 27 days in a row, and here's day 28 and it's up again. So I think that's what we're going to see, certainly not in 2013, probably not in 2014, but the move ahead I think is going to be dramatic, it's going to be impressive, and now is the time to buy. And if it's one thing I've learned with 40 years experience investing, and that is that good investments are not bought at bottoms. People do not buy bottoms. I had the website up. Silver was the lowest inflation-adjusted price it had been in history, and I couldn't get anybody interested in my work.
Wow.
And I have to add on to that, Phil, sorry, but the only ones that really seemed to get it were like Warren Buffett. He bought 129.7 million ounces of silver. Bill Gates, through Bill Fleckenstein's motivation, bought a lot of Pan American silver, and George Soros started Apex Silver Mines. So the billionaires, not the millionaires, the billionaires are buying silver at the bottom. I was buying silver at the bottom, but boy, it was a hard time. So here we are again when people really should be interested in this sector because it's low and the stock market's going higher and higher, where you should be contrarian, but, it's not happening.
I know this is just a snapshot, David. The silver down 28% this year. Obviously a good time to buy. Is there a silver lining here for us?
Well, I think there is. I mean, unless I'm missing something, the fundamentals, I think, are stronger than ever. I mean, basically my premise, and I started off my lecture with this, isn't that, silver is a cure-all for every ill in the financial system, but it certainly helps. Secondly, that the idea that the normalcy bias, I call it, that things are always going to be like they are today, tomorrow, is wrong in my view. These fiat currencies have always had problems, and we're seeing these problems over and over again, but people seem to ignore it. They see it right now. I mean, they're tired of the story, I think. It's like, oh, you guys have been saying that, and nothing's happened, and, I kind of give up, like, you're crying wolf. I don't see it. It's not going to happen. I should, get out of silver, gold, get out of my mining shares, whatever. Mm-hmm. Look at the stock market. So they're kind of easily distracted. And I'm not saying everyone, but it's kind of like I said, it is the idea that you should be buying when everyone else is selling, and that's right now.
Are we going to see more volatility over the summer in gold and silver markets, Dave?
I think we're going to get a relief rally into late June, probably third week of June, and I think it'll bring a little bit of life to the market for a little while. And then I believe that we're going to see it drift lower. I don't think the ultimate lows are in, but I think we're close. I think it's going to be summer doldrums again.
Okay.
Barring, of course, that black swan, and no one can predict that.
David Morgan from silver-investor.com, our guest here on This Week in Money. One of the things you and I were talking about off the air, silver, not just a precious metal, it is also an industrial metal. You were talking about some new uses for silver.
Well, going over some old ones. First of all, that a lot of people don't know, this is really a silver fan, is that silver's been used in clothing, textile industry more and more and more, especially in athletic clothing. And this is continuing to go. Patagonia, if I'm pronouncing that right, it's Patagonia, is offering odor-resistant outerwear. This is another company that's coming on board. And also what you're going to see, and you can get it, they're kind of rare right now, is where you buy a sweater or some outer garment, and it has a silver threading, and you can actually adjust the temperature on it. So let's say you want to dress light but stay warm up in Canada during the winter.
Yeah.
And you could have a little rheostat on it, kind of like crank it up to whatever temperature you want when you're walking between buildings, and then when you sit down in the theater, you can turn it down. I think it's kind of incredible, but this is the idea we're going to in the industrial market with silver. Just one of many things. I mean, silver is the most used commodity for applications outside of oil. Oil, of course, has tons of applications, much more than silver. Mm-hmm. But silver, as far as the metals are concerned, is used the most in all kinds of diverse products.
David Morgan, our guest here on This Week in Money, over at goldseek.com. They're talking about the difference between physical and paper markets. Silver and gold, the imploding bubble is the title of the piece. And they're talking about the big demand for physical gold and silver.
You know, it's been one of the premises, again, of me and many others that, you know, these are two separate markets. You've got the fiat fiction and the physical reality. And someday this is going to, you know, be a really big problem for metals investors that don't understand what's going on. Right now, really on the gold side more than on the silver side, there's all kinds of anecdotal evidence that some of these physical gold purchases that have been made are not being honored. Swiss banks claiming that they're not going to get the metal. They're going to have to settle in cash. Dutch bank did that formally. That one can be proven. That's on the Internet. Some of these funds that claim that they're not getting it. Funds that I know for a fact, because I deal with some of them, have moved out of the ETFs, sold their paper ETF gold, and bought physical gold. China and Russia continue to buy physical gold. So there is a discrepancy between, again, the physical reality and the fiat fiction or the paper fiction. And this is going to manifest. The last one is the COMEX. The amount of gold physically on the COMEX is ridiculously small relative to the size of the gold market. And that's being drained off rather rapidly. And maybe that's the choke point. I'm not sure. But somewhere along the line, someone somewhere is going to continue to not get paid in physical that should be, and something's going to happen. It is happening. There's lots of cases, but exactly how it will manifest to where everyone gets it. In other words, even the New York Times has to report it, and the mainstream press has to acknowledge it in some fashion. And I don't know when that's going to take place, but it will. And then you're going to see two prices. You're going to see the real price and the paper price, and the paper price may just kind of go away, meaning that the COMEX or some of these exchanges are going to have to admit reality. I mean, this thing in Hong Kong with this exchange that basically looks at, from where I stand right now at the end of May 2013, looks like it was a fraud. I don't have all the information. I don't like to use that term lightly. But this thing is being investigated, and it doesn't look very good. And a lot of people, myself included, looking back a few months prior, thought, you know, this exchange was on the up and up. Yeah. So lots going on there, Phil, that, you know, it almost hits the conspiracy theory guys. But the facts speak for themselves. And the facts are physical gold is hard to obtain. In some cases, they're not getting what they should.
One of the most interesting things to watch, Dave, is coin sales. They're always a good indicator. Here's a couple of interesting numbers here. Silver Eagle sales at the U.S. Mint, just crossing the 20 million mark. U.S. Mint running out of $5 American Eagle gold coins a month ago. So there's a huge demand here.
Absolutely true. Well said and good insight. If you go back just maybe 5-6 years, the average sale of Silver Eagles is about 10 million a year.
Wow.
And now we're at 20 million, and we're about halfway through the year. And it's the little guy, I think, that's going to take down the silver market. We just spent some time speaking about the gold market, but the silver market is mostly smaller investors. Not all, but many. And we're going to see, I think, those, coin stackers or silver stackers as referred to, again, the physical reality will take over the paper fiction, and that day of reckoning is coming as well. And which one's going to happen first, gold or silver, I'm not sure. It certainly looks as if it's going to be gold right now from where I stand, but either one could take place. And again, no one can really forecast when, but we're getting close.
We also have a mint up here in Canada, the Royal Canadian Mint, David, and they have a new silver coin. You were telling me an ounce and a half silver coin?
Absolutely, Phil. It's awesome to hand it to the Canadians again. The Royal Canadian Mint produces first and currently the only 1 1/2 ounce silver bullion coin. It's the 2013 Silver Polar Bear. It says $8 on the front of it, which has very little bearing to the physical price. It's 4/9 fine, which Canadians always do, which I admire. You're the only ones that do 4/9 coins. And, of course, it's got the Queen on the back. I'll leave my comment aside on that. Polar bear on the front. Coin sells for about a 30% premium, and it's available for most of your bullion dealers. So it's kind of a cool-looking coin. I am not a big coin collector type guy, but on these situations where you have these bullion coins that are unique like this, I think it's worth picking a few up because you never know when the series will be stopped or the limited mintage, and they could get a pretty good premium on them over time.
Dave, let's talk about gold for a second. It's below 1,400, down 18% so far this year. Sell-off, I guess, probably is healthy.
So I think it is healthy. I mean, all these bull markets, the function of bull market is to shake off as many people as possible. Boy, judging from the enthusiasm at the World Resource Investment Conference, move is pretty low. I think that bull market's doing its job. It doesn't mean it's over, but it does mean that we're going to have to climb that wall of worry. I think long-term investors, again, and now are going to be very happy.
What about the CFTC data? They're always interesting to look at. They're showing the net long position of non-commercials, the smallest since November 2008. That's interesting.
Very interesting. I addressed it in this month's issue of the Morgan Report that will be coming out here the 1st of June. And it is a very strong indicator. Every time I've seen this in the past, basically we get a pretty good move up. That's one of the many things I'm looking at to forecast this brief, strong rally over the next few weeks in the gold and silver markets. Again, time will tell if I'm right or wrong, but it looks as if we're ready. We're ready for a springboard up. Again, I don't think it's going to just blast up and away we go. I think it's going to be a nice enough move that people are going to be happy, especially if they can trade it. But I think, again, we're going to see it fall back off and hit probably the August low.
You'll find David Morgan at silver-investor.com. It's home of the Morgan Report. Follow Dave's Twitter feed at SilverGuru22. Hey, David, it's always good to talk to you. Thanks for your time, sir.
Thank you, Phil. Thanks.
This Week in Money is archived online at talkdigitalnetwork.com.
Danielle Park is president and portfolio manager of Venable Park Investment Counsel. She wrote the best-selling book, Juggling Dynamite, and you'll find her blog at jugglingdynamite.com. Hey, Danielle, it's good to have you back on This Week in Money.
Thank you, Phil.
You were here in Vancouver at the World Resource Investment Conference a couple of days back. I don't want to put a lot of pressure on the folks at Cambridge House, but you said you had a strong sense of déjà vu here.
Yeah. Well, the thing was that it's sort of like there's certain people that have grabbed on to ideas in the last 10 years, and that's their theme. And they keep playing that theme over and over, regardless of what asset prices have done. So in the commodities crowd, the theme was this insatiable Chinese growth story and how that would drive, asset prices indefinitely straight up. And they grabbed that at some point before 2008, and most of them kept telling people that all the way through. And then we got that rebound from the bottom of 9 into 11, and so people were reaffirmed in their belief system and said, "Oh, you see, we were right. It wasn't that there's a slower growth world. It's that the financial crisis came out of nowhere and hurt things in general, but now we're okay again." And of course, it's like a Monty Python skit, where you're missing your limbs, and they're saying it's only a flesh wound.
Mm.
So I found that there's a fair amount of cognitive dissonance in the world. There's a bunch of speakers that are still saying, 'tis only a flesh wound, and the things that they've been telling people have been down to the tune of 30, 40, 50, 70%.
Wow.
So I'm amazed. I marvel at the ability of the human mind to, to continue to insist on its own view in the face of all the evidence to the contrary, and also it seems the appetite for people to keep following some of those people. I find that remarkable as well.
Meanwhile, out here in the real world, a lot of mixed signals this week. The Thomson Reuters University of Michigan Consumer Sentiment Index reaching its highest since July 2007. Meanwhile, consumer spending falling in April for the first time in almost a year.
Yeah, there's a lot of incongruous things there. I mean, the savings rate is plunging, so we know that whatever spending consumers are doing, again, it's not coming from real wage growth or from new jobs. It's coming from whatever savings they had and whatever consumer credit they can get their hands on. They were doing some refinancing with mortgage rates at all-time lows in the U.S. A few months ago, Phil, so they were able to have some cash flow savings, and I guess that supported some spending. Of course, mortgage rates spiked again in the last couple of weeks, and we saw a huge fall off in refinancing activity. I think it was down 10% in the latest read. So you've got consumer spending now falling since I think it's the first time in about a year. At the same time, consumers reporting apparently that they feel, pretty good. So it's pretty amazing. I think, unfortunately, sometimes consumers report feeling pretty good just as they're about to fall off the cliff again.
Yeah.
Like this same level they reported of contentment was in the fall of 2007, and we know how that went.
Should we put much stock in GDP figures here, Danielle? U.S. economy figures just came out, 2.4% in the first quarter. Canada's GDP, 2.5% in the first quarter, its fastest pace in a year and a half. Is that a big deal? Does that really mean anything?
Well, it's some indication. It's one of the variables. It's likely to be changed as we go along.
Sure.
And the other thing about the American GDP numbers, Phil, if we remember, originally the sequester was supposed to hit at the beginning of the year. And of course, instead, and the payroll tax stuff, and instead that was postponed until March the 1st. So, of course, March the 1st is the final month of the first quarter. So when we see that GDP wasn't hit perhaps as badly as we'd initially expected, we have to take into account that it was deferred by a couple of months.
Sure.
So we'll see. I mean, the thing is that we get a few cracks at this guesstimate, and we'll probably come back and revise it later. And then a lot of it depends on the inflation rate that the government is using to assess the real number. And that inflation rate is a bit of a wild card at the moment. You're seeing a lot of deflation, Phil, in a lot of aspects, and I think the key theme at the moment is back to deflation. That's certainly that's certainly my take on the facts that we've seen in the last while, and it's also, I think, the take of the Federal Reserve in the U.S. I think that they are worried about deflation, and so as that goes along, things like, for example, lumber prices have fallen something like 30% year to date. So that's picked up in the last couple of months pretty significantly. So it's just, I think that's an example of commodity prices continue to say deflation, slowing growth. Oil demand, Phil, falling. Oil is now trying to fight. West Texas crude is trying to stay above 90. And OPEC, is having a meeting today saying their biggest concern is slowing global demand. So you have all that sort of thing going on, and whether we had modest growth in the first quarter of 2013's GDP really doesn't negate the vector of that trend.
One of the numbers we do pay attention to, Danielle, is jobless claims in the U.S. They rose this week 10,000 to 354,000.
Yeah, so I think the story there is, payrolls have been averaging about 200,000 jobs a month over the last 6 months, and the reality is it's less to do with new jobs or new hirings and more to do with less firings. We've definitely seen a slowdown in the pace of firing going on in the American job market. So I think, again, that's the vector of the trend. But at the same time, if we're right about this slowing growth theme, and going into sluggish in this quarter, you could see a spike back up in that. So it's a pretty volatile series, but I still think that you're likely to see more weakness in the job market from here rather than strength.
Got bad employment news out of Europe today. Eurozone unemployment hitting a record 12%. Spain and Greece feeling the most pain. A total number of unemployed job seekers. Get this, Danielle, in Europe, 20 million.
I know, it's incredible. Well, the International Labour Organization came out this week and said that the unemployment rate is going to move above 200 million in 2013. That's globally. These are workers that are willing, able, and looking for employment, and that is a big problem, and it's a big problem for youth in particular, as we've discussed before, and it's a big problem for the older generation if the young people can't get a foothold, if they can't get started, if they can't, pay into pension plans and contribute to the healthcare system, and they can't, be able to buy houses. This is all a big problem for every age of the people in the economy.
Danielle Park from JugglingDynamite.com, our guest here on This Week in Money. And in the markets, of course, we had another Turbo Tuesday this week. 20 out of 20, almost a perfect record. The longest Tuesday streak since 1900. I guess the markets are loading up on Bernanke.
Isn't that an amazing fact? It's just another one of the madness metrics I think of when I think of what's been going on in the world and the way the markets have been rigged and jigged and moved. It's like, that's the day that we see the Federal Reserve in there doing its POMO, its buying in the Treasury market, and it just really gets recycled right back into stocks. So it's a very alarming, really, because it just goes back to my point, which is that this has been a very irregular, unusual, artificial market for the past, really since 2010 when they started doing QE, but it's got a lot worse in the last year and two. And you're left with, these computer algos just swinging for headlines and trying to anticipate and front-run everyone. And they've been really successful at it. But at some point, as that's gone along, it's driven back real serious people from the market and sort of saying, what is going on here? So I think in the end, it'll be self-defeating for the for-profit exchanges because they've let it all go to the way of the crazies and the mad drivers, and that means that regular traffic continues to retreat. So it's really shooting themselves in the foot. They've been saying, well, we need revenue, because volumes are down 58% from where they were in 2007, and we need more people to participate in the markets. Maybe they have to somehow devise two markets. Maybe they need a market where all these people that have invested in these, incredibly fast computer systems can go and race each other on that particular highway, and the rest of us that are trying to actually use the markets as a legitimate utility can have our own place, because the two can't really coexist.
One of the fun things we've been talking about for quite a long time about the market is this predilection with dividend stocks. People getting paid to wait. Here are a couple of fun headlines today from the media. CNN Money, the dividend craze may be over. Reuters, dividend stocks lose shine as U.S. bond yields rise.
Well, exactly. There's a part of the argument is that the reason people have been so attracted to dividend stocks in the last while has been certainly to do with very low interest rates, and I think that that's true. And we saw a flow of net equity flow into dividend-paying stocks and equity mutual funds in the last month, which we hadn't seen for some time. Unfortunately, that tends to be another sign of a top when the investing public finally capitulates and starts to have more flows into the equity markets than out, which we've seen, they were flowing out for the last couple of years. And I think out of desperation and lack of cash flow, people have been sort of moving back in. Even bond funds have actually increased their equity exposure in the last while. So that's all sort of troubling and desperate for yield. But it tends to be at the very wrong time. And another thing I've noticed is all the corporate buybacks that have been going on. If you look at that historically, it's also a typical sign of a top because they have nowhere else productive to deploy that capital. So these things just drive, prices even higher, yields even lower, and downside risk all that much higher again.
Another crazy week in the bond market. Treasuries giving up all their gains, and yields now rising to the highest levels, Danielle, in over a year.
Yeah, we're watching that very carefully. I mean, I am well aware that at some stage rates will have to start to trend higher. At this point, though, I think that this is a typical spring test. We saw one of these fill exactly almost of this magnitude in 2009, in the spring of 2009, and another in the spring of 11, where you get the, a lot of what's happened is you've seen repatriation of money back from the U.S. market to Japan, for example, in the last while. Maybe that speculative flows again as the Japanese market really went crazy through the roof, and you saw Japanese dollars getting brought back home. Maybe that was the attraction. I think it's more a fund flows issue than it is anything to do with a likelihood of sustained higher interest rates. However, we track that very closely. The 10-year Treasury yield, the sort of upside resistance from here is around the 225 range, and we're not there yet. And it every time we have a spook in these markets, the bonds sort of receive bid again, and the yields falter. So unless we have a really dramatic change, so far this just looks like another spring swoon, and it's likely that it'll reverse again. I still think, as I say, evidence deflationary, commodities signaling further downside, and that means probably bond yields will continue to move lower again rather than higher, at least in the near term.
We're talking to Danielle Park from JugglingDynamite.com here on This Week in Money. We've been full of news about the Canadian banks this week, reporting pretty good profits. Royal Bank, second quarter, up 26%. CIBC posting a second quarter profit that beat the street. CIBC also raising its dividend. Meanwhile, and I didn't see this anywhere except for a couple of places, U.S. banks reporting their largest quarterly profit on record.
And why wouldn't they, right?
Yeah.
They've had the most fortuitous circumstance of all time. The most help, the most liquidity, the least regulation. They have the most capture of Congress. I mean, really, if they can't make money, then I don't know who could possibly make money in this environment. So they've also, let's not forget, they've also still never valued properly in terms of market value the junk on their balance sheets. So, they get to play in an arena where they don't have to do any fair disclosure, no transparency. They get money for free. They get to lend it out to whoever's desperate enough to borrow it, and they get to extract their whatever preferential terms they want. I guess it's good for them. But at the end of the day, and here's the great corrector or, end of the cycle, is that without consumers, without people who can borrow, without, customers with financial products that they're willing to buy, those banks can only feed on that sort of nonsense for a while, and then it eventually will come back to prove that they are in trouble again.
Well, we're talking about big banks. Tell us about this clip you've got on the Juggling Dynamite blog with Neil Borofsky.
Well, he was the special investigator for the TARP fund in the original bailout. Remember that, Phil?
Yeah,
Remember when bailing out the banks was like a novel concept instead of a perpetual condition? And he basically wrote a book after that talking about what went on, and he's now a commentator. And he was just pointing out that they still write something like, I think every piece of legislation that's been proposed ends up being rewritten by the bank lobby to the tune of like 70 or 80% of it. And I mean actual line-by-line writing of what actually becomes law. So they're a very effective lobby group, very effective.
Always great videos and terrific Corey Venable charts over at the JugglingDynamite.com blog. Danielle Park, President and Portfolio Manager of Venable Park Investment Council. Hey, thank you, Danielle.
Hey, thanks, Phil. Keep your head down, eh?
This Week in Money is archived online at talkdigitalnetwork.com.
David Galland is Managing Director of Casey Research. He's also Managing Editor for the Casey Report, and he contributes to Casey's Daily Dispatch. He's online at caseyresearch.com. Dave, it's good to have you back on This Week in Money.
Nice to be here.
Want to tell our friends about the Casey Research Fall Summit in Tucson. That's coming up in October, 4th, 5th, and 6th. More details at caseyresearch.com, of course. Basically here, I'm assuming here that the world here is run by idiots, David, and if you want to survive, you got to go to this thing to separate the truth from the BS. Is that basically how it's happening?
Well, it's become increasingly important. You look at the world that you live in and you say that everything is as the sort of mainstream media says it is, or it's not. And if it's not, what is it? And according to the mainstream media, we are now out of the recession. It's full guns ahead, and everything's going to be just peachy. And in reality, that's far from the truth.
Okay, so what you're doing is presenting an alternative point of view to what we're led to believe is actually happening, right?
Well, it's actually, the difference, most people look at news headlines, and it's sort of a heuristical way of looking at the world. You just sort of take visual cues and you say, okay, the headlines say it's okay, so it must be okay. But what we do at these conferences is to really go into much more detail, systematically looking at the actual data and hearing from people that really know. I mean, not just, guys off the street, but people who spent their lifetime studying this stuff. And, get to the point where you actually understand viscerally what's going on and what the actual lay of the land is. And I think it's essential, especially in this environment and in an area or in a period when there's so much misallocation of capital and so many people, let's say, piling into the stock market and into the bond market, and there's still a huge amount of money in bonds. Mm-hmm. And, that's a very risky thing to be doing at this point.
David Galland from CaseyResearch.com here with us on This Week in Money. Let's talk about some of the topics that you're going to be covering at the summit, starting off with Obamacare. Now, we know up here in Canada not very much about Obamacare. We know it's an overhaul of the healthcare system down there. But is it a good idea or a bad idea? What's your take?
Well, I mean, everything I've seen is it's a bad idea. And that's strictly because you've got a government that is already mismanaged the medical system such as it is down here, is now going to take over pretty much the whole thing. And nobody really, the comment that Pelosi made, which was that you have to pass the bill in order to find out what's in it. Well, they still don't really know what's in it. And but the things that are showing up, or the indications are that you're going to have a huge new level of demand on the healthcare system in the U.S., and it's just not going to be the doctors. It's not going to be the system to meet that demand. All of a sudden, when healthcare is free and anybody can walk in the door at any time for any reason, pretty much, then it's going to lead to all sorts of things that Americans certainly aren't used to dealing with in terms of rationing, in terms of this sort of thing. So, the current healthcare system is sort of a quasi-government operation as it is. And challenge, but this takes it the whole way, and it's going to be a big change for Americans.
One of the big factors, of course, of the same problem we're having here, and that's a demographic problem. Baby boomer health costs have got to impact something like Obamacare.
Yeah, absolutely, and we're just it's sort of a key factor. It's something we're going to be dealing with the rest of our lives in terms of certainly in the U.S. And in Canada. You've got the baby boom bubble is coming through, and that's going to cost a huge amount of money in terms of entitlements and benefit payments and all this sort of thing. So the deficit, at this point, I mean, between now and is projected in the next 10, 15, 20 years, it's going to go up to 200% of GDP. In terms of the federal debt. And that's clearly unsustainable. So, but we're headed there.
David Galland from CaseyResearch.com. We're talking about the summit coming up in Tucson. Some of the things that they're going to be covering. Of course, we can't avoid central banks. The fiction that we're used to is that the picture of Helicopter Ben and the Fed printing money. And the reality, of course, is the Fed does nothing of the sort.
No, they sell bonds. They're buying bonds. It's a form of creating money out of thin air, but it's not actually printing money.
David Galland from CaseyResearch.com. And let's look at the U.S. stock market. One of the things that you'll be covering at the Fall Summit, stocks bouncing back after the biggest hit in 4 weeks. Based on what today? Good news from the housing market and people thinking that the Fed's still going to save the show here.
Pretty much. I mean, we're now at the stage of the game where the hopes of the market are pinned upon the idea that the Fed is going to continue to bail people out. The Fed is going to continue to be there and to continue to provide liquidity to the economy, and that's the driving force for the economy, for the markets at this point. And of course, the economy and the markets aren't the same thing. Then it's a pretty thin veneer, if you will.
David Galland from CaseyResearch.com. Let's look at the bond bubble that we are experiencing this week. U.S. 10-year Treasuries, their worst day in almost 2 years. Prices falling, yields jumping. What the heck is going on in the bond market, and does any of this make any sense to you?
Well, we've got Lacey Hunt, who used to be the economist for the Fed. He's going to speak at the conference. He's spoken there a couple of times. We've also got guys like James Rickards there, Donald Cox, of course. I think your readers probably listeners are familiar with him. they're going to be looking at the whole question of U.S. interest rates. I mean, how you can have record deficits, record debt, and the lowest interest rates in 50 years, is a real conundrum. And at some point, this thing rolls over. And are we there? Are we getting close to that point? I don't know. It'll be something I'll be sitting in the audience looking to hear more about, because it's really becomes a pivotal question. Once the Fed starts losing control of interest rates, then this whole show's over.
How much of an influence, David, is the Fed on the bond market in the States?
Well, they're huge.
Yeah.
I mean, it's not for any other reason than the perception that the Fed has the power to step in at any given time and keep interest rates low. By becoming or continuing to be the buyer of last resort of treasuries. So that perception is there, and as people believe that they're the backstop, then they're going to if the Fed says they can keep interest rates down and keep them low, then at this point they still have enough credibility that people believe that. So they play a huge role at this point.
David Galland with us on This Week in Money. And gold today, back over $1,400. The dollar weakening a little bit. We are going to be talking about gold down in Tucson. And what do you see happening going forward? What's driving the gold price? What do you look at from this point on?
Well, again, the way I view gold is insurance, generally speaking. So I tend not to pay too much attention to the short-term volatility of it. But, again, it sort of goes back to this question of the longer-term picture. Is the longer-term picture for debasement of the currency, is that case intact? And I think the answer can only be yes at this point. So I don't really worry about the longer-term case. I think in terms of the short-term case, I think people should be very encouraged by the fact that every time gold has fallen down into sort of the mid-1300s, there's been a huge upswelling of physical demand right around the world.
Mm-hmm.
People can't get enough of this stuff. So that feels to me like that's putting in a bottom. That if below 1,400, people feel they must run out and buy gold, physical gold, then I think that's a good indication that the bottom is somewhere in that neighborhood. Now, as far as the upside is concerned, who knows? There's so many black swans floating around.
Yeah.
There's so many things that can go wrong, that something eventually will go wrong. But even if it doesn't, just go back and look at, over a period of time, the debasement of the fiat currencies, and I'd rather be hanging on to some physical stuff versus the paper stuff.
A lot of folks, David, wondering about the future of the miners. We've been hearing nothing but bad news for as long as I can remember talking about it. They are still getting pounded by commodity prices. What are we starting to see here? Are you going to be covering any of this stuff down in Tucson?
Oh yeah, no, we'll be talking about that in depth. I mean, it's a classic. You've been around, I've been around, and you see this sort of capitulation. It only happens once every, I don't know, is it 10, 15, 20 years, where people just don't want to even think about the juniors, especially the bigger miners. They'll always have a certain institutional following, especially as they've come off a bit. But the juniors at this point, nobody wants to own these things, and that to me is a classic contrarian opportunity. I mean, I've been buying selectively, and the nice thing about this kind of market is you can buy things selectively. You can be as selective as you want. You can go for companies that only have well-known large deposits, that have cash in the bank, that have top management, that are in safe mining jurisdictions, and you can just be as choosy as you want, and you're still going to be buying them at a 50% discount or more. So it's a buyer's market. There's no question about it. You can get great deals on financings at this point. So if you have any belief whatsoever in, and not just in gold and gold mining or silver and silver mining, but in the whole idea that you need commodities, to make the world run, then this is a buyer's absolutely the best time to be buying, or certainly to be studying your companies and selectively picking things off on setbacks.
Making up your shopping list.
Pretty much, and this process has been going on for a while. And it could continue to go on for a while. You can't argue. There are a lot of people, a lot of companies letting go of their geological teams. This is just the classic signs of the bottom here. But it could go on for a while longer.
David Galland from KCResearch.com here on This Week in Money. And one of the things you're going to be covering in Tucson, deficit spending. Good news from the Congressional Budget Office today. A $642 billion budget deficit for the fiscal year. That's down more than $200 billion from February. The smallest shortfall since 2008. I guess that is good news, is it?
Well, they say it is, but of course, before this whole thing kicked off, the deficit of that magnitude was unheard of.
Yeah.
But I don't trust them. I don't trust their calculations. I don't trust how they add this stuff up. They have shown the government has shown an absolute willingness to fudge the numbers or change the reporting statistics, as needed to favor themselves. So I don't believe it. I think the data is generally rigged, and I think that the actual situation, especially if you look at unfunded liabilities and this sort of thing, the situation is much worse than they're making it out to be. But this is what they do, and so again, this is the kind of stuff that we need to cover and will be covering in Arizona, trying to look at the real data and how bad is the economy, how far off the tracks is it, and is there any chance of it coming back to something that looks reasonable? And I don't think it's there, but we'll find out.
One of the other topics you're covering, the currency war. CNBC reporting today, new Bank of England Governor Mark Carney, Canada's own, may depreciate the pound. The UK joining, get this, what CNBC calls the global battle of countries competing to soften their currencies.
So, well, this is, again, isn't it all part of the same continuum?
Yeah.
I mean, it's the only option they have, or as far as they're concerned. In terms of policy options, it's all they have. The only other options are to actually cut back the size of government, to cut back the size of social programs. And we've seen what the public in places like Greece and Spain think about trying to do some austerity. They don't like it. And so they head out in the streets. And right now, that's just off the table. So, one of the few remaining policy options is to try to weaken the currency and hopefully jumpstart exports. And so they're trying, but this is a global phenomenon. So it's a race to the bottom, which means that the things tangible are going to be going up.
So what's the end game here, David? When do we hit the bottom, and what do we do then?
I have no idea, Phil. I really don't. All I know is you got to. My personal view at this point is you got to spread things around as much as you can.
Yeah.
And so we urge people to diversify internationally, to diversify between asset classes, to diversify between financial institutions, because they're all sort of bent and hooked into each other at this point, and if you have too much money in a single institution, you can lose it all. It's a really challenging environment for people, and so spread it around and favor things more tangible, because stuff that at the end of the day you still own, whether it's productive real estate or some gold or silver. An operating business, real estate in the right places. These are all things that'll help you get through this. But we're not out of the woods, and I don't think we're going to be out of the woods for another 5 to 10 years, frankly.
David Galland is Managing Director of Casey Research. He's Managing Editor for the Casey Report, and he contributes to Casey's Daily Dispatch. He's online at CaseyResearch.com. Don't forget Casey's Fall 2013 Summit in Tucson, Arizona, October 4, 5, and 6. Former Congressman Dr. Ron Paul, a lot of great folks are going to be there. If you are concerned at all that the world is run by idiots, please go to CaseyResearch.com and click on the banner. Hey, David, thanks for this.
My pleasure. I'm happy to have spent some time with you.
Thanks to our guests, David Morgan, Danielle Park, and David Galland. And thank you for listening. I'm Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.